The opinions expressed by Retirement Depot and guests on this program are their own and do not reflect the opinions of this radio station. All statements and opinions expressed are based upon information considered reliable, although should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and, unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, it is recommended to seek advice from a qualified tax professional or investment advisor to determine whether it is suitable for your specific situation.
If you could lower the fees you're paying your broker by 60%, would that be of interest to you? If it was possible to lower market exposure volatility by 70%, would you consider that as well? What if you could possibly increase earnings? Would that interest you? If you answered yes to any of these questions, then you should be calling us right now at 1-888-381-1626 to find out how you may be able to do just that with our retirement track solutions. Call us now at 1-888-381-1626 and ask about our Retirement Tracks approach to getting you on the right track to your retirement destination. Call now, 1-888-381-1626. Retirement Depot is a registered investment advisor.
Reach your retirement destination. Don't get sidetracked or derailed. Let the folks at Retirement Depot get you moving on the right trail. For financial solutions and advice, it's your future, you can't get it back. We're Retirement Depot, we'll get you on the right track. Call 888-381-1626. We're Retirement Depot, we'll help you make sense of it.
Hello, this is Pete Moss. Welcome to Retirement Depot Radio, your premier financial radio program hosted by Herb Hickmore and Ken Gulliver. Make sure you and your retirement funds are on the right track for an on-time arrival at your retirement destination without getting sidetracked or derailed.
We're Retirement Depot, we'll help you make sense of it.
And now, here to talk with you about getting your retirement on the right track, your hosts, Herb Hickmore and Ken Gulliver.
Thank you, Pete. Are you tired of the same old proposition? Give me all your money, pay me to manage it, and in 5 to 10 years we'll see if it was the right decision? If so, listen to the show and give us a call. We have a refreshing approach to your financial future.
Well, folks, we've got a great show lined up for you today on Retirement Depot Radio. Welcome back once again. I'm Herb Hickmore. I'm here with
Ken Gulliver.
We're your co-hosts for today's show. Today we've got John Bogle. We actually interviewed Mr. Bogle, and we've got this in 2 shows. So today we're going to be doing part 1 with Mr. Bogle. It's an exciting show. John Bogle is a gentleman that started Vanguard Group. Ken, why don't you tell us a little bit about John Bogle?
Thanks, Herb. John Bogle, 77 years old. He's founder of the Vanguard Group Incorporated and president of Vanguard's Bogle Financial Markets Research Center. Now, he created Vanguard in 1974 and served as chairman and chief executive officer until 1996 and senior chairman until 2000. Now, he had been associated with a predecessor company since 1951. Immediately following his graduation from Princeton University, magna cum laude in economics, he's a graduate of Blair Academy, class of 1947.
You know, John Bogle came out of college in 1951, and he got challenged almost immediately. He went to work for Wellington Group, and he was reading Paul Samuelson's thesis, one of the brilliant minds of our times when it comes to investing. And Paul Samuelson was more or less demanding that somebody somewhere start an index fund, and John Bogle thought, why not me? Today, it's grown into a very large mutual fund organization. Ken, how big is Vanguard today?
Vanguard's pretty big, Herb. They're, like you said, one of the 2 largest mutual fund organizations. They're got about 120 mutual funds with current assets totaling $1 trillion.
Very large company. Well, we had a lot of questions for Mr. Bogle, and we're going to play one of these audio portions here in just a minute. And the question that we asked Mr. Bogle was, why did you start Vanguard, and how did that happen? And listen closely to what his response was. Just before we listen to that clip, I wanted to give everybody one last chance to call in and get our consumer guide. If you'd like our consumer guide or a free risk analysis, make sure you give us a call at 1-888-381-1626. That's 888-381-1626. Give us a call now or anytime during the week. We'll make sure that you get our free consumer guide. And if you'd like some educational material that's on the show today, if you'd like to learn a little bit more, don't forget to go to retirementdepot.radio.com. Okay, we're going to continue now with this first audio soundbite from John Bogle. Once again, we asked him, why did you start Vanguard and how did that happen? And here's Mr. Bogle's answer.
Well, actually, it's a funny story because I came up with the basic concept even earlier in my senior thesis at Princeton University in 1951, when I was still in college.
Wow.
And it was about the mutual fund industry, how it could be better, and how mutual fund performance could make no claim. This is, I think, pretty close to a direct quote from that senior thesis, and no claim to superiority over the market indexes. In other words, funds can't win. That's not the... obviously, we now know, of course they can't, because they are the market, and they take out a lot of costs, and they can't overcome that, so they're going to lose. This industry is now $12 trillion, give or take. The common stock fund portion is pretty close to $7 trillion, and so it's big. The large firms have difficulty in maneuvering, but in any event, there was the germ of that idea back in 1951 by name. And we got into the 70s. I happened to get fired from my job as head of Wellington Management Company. We started this new company, Vanguard, which was dedicated to being run for the shareholders and not for the managers, which meant very low cost. The managers' profits were not part of our equation. And so the greatest example of the importance of low cost is to start an index fund. You can't charge 2% a year for an investment expert because you don't need any investment experts. All you do is buy every stock in the S&P 500, Standard & Poor's 500 index, and weight it by its weight in the index. I was kind of thinking about the idea and proposing it to our board, and a wonderful article appeared in the Journal of Portfolio Management by the eminent economist Paul Samuelson, the Nobel laureate in economics, and he demanded somebody somewhere start an index fund. And I thought, why not me?
So there's the answer to our first question to Mr. Bogle. And Ken, for as much as he is and for much as he knows, he sounds like a pretty humble man, doesn't he?
Yeah, he does, and in fact, it's a pretty amazing man. In 2004, Time magazine named him one of the world's 100 most powerful and influential people, and it's kind of amazing. He talks about how the fact that he stands on the shoulders of giants. He's a graduate of college, but he doesn't have his master's degree. He doesn't have his PhD, and yet 61 years of applying himself in an industry and being a student of his industry, where many people aren't students in their own careers, has given him so much, and at the same time given us and investors so much.
He sure has, and it's not just any industry. If you're listening there, he said it was a $12 trillion industry.
That's right.
And he talks about fees, and one of the things that we do here is take a real close look at fees. And even the $12 trillion industry today, still 65% of the funds out there are sold on a loaded basis. So you've got to pay to get into a fund, and then you really don't know what it's going to do. And if somebody's charging you 2% per year, Ken, to go in there, can anybody control those costs or manage them?
Oh, it's absolutely controllable.
Yeah, it's one of the things that we always say is control what you can, manage what you can't. And we've got some proprietary strategies that we apply in this industry that will help, or that have indicated that they will reduce cost. And once again, if you'd like to get our consumer guide on this, there's no cost to you. Just give us a call anytime at 888-381-1626, 888-381-1626 to get your free consumer guide. Or if you'd like some educational material that is provided through the show or through our website, don't forget to go to retirementdepotradio.com. One of the things that John Bogle was talking about here is that the sheer size of the S&P 500 and how if you go into an index fund, you're not going to pay an investment expert the 2% per year. And it just shows the advantages or the opportunities. He got fired from Wellington Funds. He heard the call of Paul Samuelson saying that somebody should start an index fund. John Bogle thought, why not me? And he started Vanguard. It's quite a story. All right, Ken, the next question that we asked Mr. Bogle, and you'll hear it in this soundbite. Listen closely to what he's answering here. Our question was, can you comment on the recent article and research paper that was published in which you describe speculation and enterprise? And here's Mr. Bogle's answer.
It's interesting. I like to put the finishing touches on these articles when I have a chance to think about them. And I just touched that one up yesterday. And actually, the better quote, going back even further than Sir Isaac Newton's quote about standing on the shoulders of giants, is when a dwarf stands on the shoulder of a giant, he can see further than the giant sees himself. Because Bogle, I have bad news for you guys, Bogle is kind of a dwarf in this world, and the giants are John Maynard Keynes and Paul Samuelson, certainly two of the, by far the greatest economists of the 20th century. They were mental giants, intellectual giants, geniuses, very thought-provoking, and they love to give their point of view. And I quoted John Maynard Keynes, Lord Keynes, in my senior thesis about investment and speculation. And he made this central distinction, which I describe in that article, between enterprise, he called it, I call it investment, which is forecasting the long-term yield on an investment, and speculation, which was the term he also used, was forecasting the crowd psychology a few weeks or months hence, and you trade around that psychology. So it's the difference between buying a corporation, if you will, which creates value, and trading back and forth with your fellow investors, always betting that you're smarter than they are, and of course some of the times you are, and some of the times you're not. But on balance, you can't be, and on balance you're going to lose, because just like going to the casino in Las Vegas or anything else, the winners offset the losers, but it's not an equal game because the croupiers, the guys raking the money off the table, are always the winners. Whether the man who buys wins, or the person who he buys it from wins, no one knows. But the man in the middle, the croupier I call him, is always a winner. And that's Wall Street today. They love all this trading because it makes money for them, and they don't really care who wins on either side of the game because nobody's going to win. It's an even bet. Whether HP, maybe to use an example today, or Apple or whatever it might be, goes up or down, nobody knows. But every time a trade takes place, both sides think they're smarter than the other, so each side thinks that their side is the winning side. They're right half the time.
Wow, that was quite a bit of information from Mr. Bogle there. The thing that I got out of that was the last part that he said that nobody can win because it's an even bet, so you can't win with balance. Wall Street are the only people that win in there, and primarily because of the fees. And he also mentioned enterprise or investment and the long-term yield on investments. Ken, what do you think about, what did you grab from what he said there?
You know, I'm glad you brought that up, Herb, because to me in that clip, it's easy to grab onto the can't win with balance idea. But if you back up just a little bit, he talks about the whole idea of speculative return. And, you know, over the years, there's been increased interest in novice investors, and that's greatly increased this speculative return and the emotion that they bring to the table. And the idea that Bogle discusses compounds the need for a safe and stable strategy for your core assets. And you know, back in 2004, that's why we worked so diligently since that time to bring Retirement Tracks, our proprietary investment strategy, to the table. And it's been helping people. It helped our clients weather the storm through 2008. Phenomenal results. So that I hang my hat on, that the whole speculation and the volatility that's created in the markets.
That's a great point, Ken. Thank you. And that one of the things that Retirement Tracks does is it puts you back in charge. Here, let me ask you a couple of questions here. If you could reduce your fees, number one question, and also if you could reduce volatility, that's a number two question, and if you could outperform the market, that's a number three question. Is that something that may be of interest to you? And keep in mind, we're talking about a $12 trillion market out there where 65% of those funds are sold today as loaded funds. So if you could possibly increase your return, decrease your volatility, and decrease your fees, it might be of interest to you. That's what Ken's talking about with our Retirement Tracks strategy. Give us a call. Find out more about it. 888-381-1626. That's 1-888-381-1626. Or if you'd like some educational information on it, remember, you can always visit us at retirementdepotradio.com and request that information. You know, Ken, you made a great point earlier when you were talking about emotion. And John Bogle, in the books that he's written, he talks about the crowd's psychology and how you can trade around that psychology. So, you know, in this last soundbite, he talked about it's the difference between buying a corporation, which creates value, and trading back and forth with your fellow investors, always betting that you're smarter than they are. And you know that you're not, and you can't win with balance. So, just mention that again, where you're talking about the enthusiasm and about how our Retirement Tracks approach can help people.
Sure. It can't be said enough. The simple fact that for years, finding investment return was just a function of fundamentals and exactly how a company worked. And as investments in the stock market proliferated and you had novice investors starting to play the game, they brought a lot of emotion to the table. And there's a lot of psychology that goes on with that. And it's created a minefield, quite frankly. And that's where Retirement Tracks is a good answer for a lot of this volatility and, as a result, the increased fees.
So basically, we can level off that playing field and eliminate some of the fear and greed that people experience in the market, that part of that psychology, because we show them a better path that perhaps they could be somewhat experiencing somewhat less risk, higher returns, and less volatility.
That's right. 3 things that the typical investor is looking for that I've found out through the last several years, Herb, is number 1, they want immediate gratification. Number 2, they want to sleep at night. And number 3, they want to keep up with the Jones. And I'll tell you, that's a pretty tall order. And I think we've come about as close as we possibly can to satisfying those 3 needs.
So, folks, if you'd like to learn more about the Retirement Tracks or like to get your free consumer guide, give us a call, 888-381-1626, or visit us at retirementdepotradio.com. We're going to go into our third soundbite here from Mr. Bogle. And the question that we asked him is, how important is cost when considering mutual funds, and how important is cost when considering investments?
Let me say a couple of things about that. One, how important is cost? In the short term, it doesn't look like it matters a lot, and particularly in a bull market, it doesn't look like it matters. You know, in those bull markets of the 80s and 90s, when the market return was 17%, who cared if you were paying 2% a year for that and earning, quote, only, quote, 15%? But now with market returns, particularly real returns after inflation, being maybe 5% is what it's going to be, 2% cost is 40% of the total return going to the mutual fund firm and 60% going to you. And, of course, you put up 100% of the capital. You take 100% of the risk, but you only get 60% of the return. It seems unbelievable. So, but the mistake people make is they say in the short run, they don't look at it quite this way, but they're looking at what the annual fee is without any conception of what it means over an investment lifetime. And if you assume, for the purposes of argument here, that the return on the stock market in the next 40 or 50 years for a young person, maybe even longer an investment lifetime for a young person today, but just the time they're investing, and say instead of getting that 7% assumed return, they get 5%, what happens at the end of the time period, that long period, is that 2% cost out of the 7 costs you about, well, you retain about 30% of the cumulative gain in that period, and Wall Street gets 70%. That's what I call the miracle of compounding of compounding of returns, overwhelmed by the tyranny of compounding long-term costs. So people ought to take a look at what it's going to be like for an investment lifetime, not today or tomorrow. Now, as to the amount of those costs, they're greatly understated everywhere. You know, each fund has its published expense ratio, which everybody should certainly know, and they run from, probably for most funds, somewhere between 0.75% and 1.5% a year, what we call in the business 75 to 150 basis points. But that's not all of it at all. These mutual funds are very active traders. They have a lot of transaction costs, which they will not disclose to you. In some cases, don't even know. But turning a portfolio over at 100% a year probably costs 0.5%, another 0.5%, another 1% a year. And then still in this day and age, hard to believe, 65% or so of all mutual fund sales are in funds with sales loads. And there goes another 1% or so. It's a very expensive way to invest that people should be aware of, the all-in costs, I call them. And, over a lifetime, even if those costs can be held at 2%, it's going to be very difficult for investors to accumulate enough money for their retirement needs. So costs are vitally important, and they're ignored because the industry doesn't even like to think about costs, number one. And number two, the best way to surmount those costs is an index fund, because an index fund is usually available, large cap index fund, S&P 500 index fund, for somewhere between 5 and 10 basis points, a tenth of 1%, let's say, a fraction.
What a great insight John Bogle had in that when he talked about Wall Street is the real winner, and they're going to end up with 70% of the money, and the investors are going to wind up with 30%. But when you drill down into this, he talks about expense ratios being anywhere from 75 to 150 basis points per year. But even below that, there's a hidden cost, transaction costs. Ken, tell us about those.
Yeah, I'm glad you brought that up, Herb, because it's something I don't want the audience to be lost on. It's easy to listen to a clip like this and say, I know exactly what I'm paying in my investments. I've got some ETFs, all is well in my world. That may not be the case. And I'm kind of surprised. One of the things he did not define very well, he mentioned it as transaction costs in the business. We refer to that as turnover, and in turnover, there's a lot of expense. And you find that in these funds. They don't have to disclose it. It's something that even many advisors don't even know how to calculate. And admittedly, John Bogle, in one of his first books, Bogle on Mutual Funds, that was written back in 1993, I guess, he talks about that and what turnover is comprised of, which is fees, taxes, and economies of scale. And I'm not going to get into a lot of it today, but the cost, conservatively, he says in his book, page 204, Bogle on Mutual Funds, is that it costs conservatively 1.2% per year if you've got investments that have a 100% turnover rate. And 100% turnover rate's very easy to achieve. That's on top of what people think they pay, Herb.
That's amazing. So on top of these numbers right here that are stated, even if you know what your fees are, there's a lot of hidden costs that you do not know about. That's great advice, Ken. Thanks very much. Listen, we're just about out of time, folks, but I wanted to give you that number one more time. If you want to find out more about this, get your free consumer guide, give us a call anytime at 888-381-1626, 888-381-1626. Or if you'd like to find out more about the show or get some educational material that we've talked about on today's show, visit us at retirementdepotradio.com. Stay tuned. When we come back, we'll talk about our guest next week.
Who is advising you on your financial matters? Retirement Depot is an independent registered investment advisor and is not owned or controlled, captive, or obligated to any broker-dealer, investment company, insurance carrier, or investment banking firm. We have no restrictions on products or investments. We are fee-based advisors and are not compensated by securities commissions. To learn more, call us at 1-888-381-1626 or visit us on the web at www.myretirementdepot.com. Call us today at 1-888-381-1626 and ask for our free retirement information kit that contains very valuable information to help you take control of your finances. Call us today and request your free retirement information kit. That number, once again, is 1-888-381-1626.
Would you like to pay zero taxes on your retirement income? You may be sitting on a tax time bomb and not even know it. Did you know that up to 85% of your Social Security income can be taxed? Our retirement information kit may be your first step to a tax-free future. Just imagine, no taxes on your retirement income and no required minimum distributions. It's time to take control of your retirement. Call us now at 1-888-381-1626. That's 1-888-381-1626. Retirement Depot is a registered investment advisor.
Well, folks, we had a great interview and a great show today with John Bogle. And I want to remind everybody to tune in again next week because we've got part 2 of John Bogle coming up. And if you thought you heard some insights this week, you're going to hear a lot more next week. So remember to tune in, same time, same station.
Reach your retirement destination. Don't get sidetracked or derailed. Let the folks at Retirement Depot get you moving on the right trail.
You've been listening to Retirement Depot Radio with Herb Hickmore and Ken Gulliver. You owe it to yourself to protect your wealth. Get on track to your retirement destination. Call us now for your free Retirement Depot information kit at 1-888-381-1626. That's 1-888-381-1626. Or visit us anytime online at retirementdepotradio.com for more information. Don't forget to tune in next week for another edition of Retirement Depot Radio.